everybody.
Good afternoon.
I'd like you to take out your homework. We're going to pick up where we left off on Monday. Hope you enjoyed your Wednesday. And we're going to be talking about fixed assets. The assets that are going to benefit the company for many years. And we're talking about depreciation. The last two methods of depreciation that we learned about were
Units
of
of output
output and
double decline
double decline and balance. So if you take out your homework, we're going to go over the two exercises that you were supposed to do on page 434. Audie, get some chalk. Okay, let's look at practice exercise 9-3B. We're using the units of output method. A truck acquired at a cost of $69,000 has an estimated residual value of $12,000. So in our numerator, we put 69,000, and then we subtract, so it's 12,000. And we're gonna divide it by the total number of units over the life, right, what you said is how much? 300,000 miles. When you do that,
you don't change the hours?
it says miles, no, it's miles, whatever they say the units are, that's what it is. If it was a company that was using hours as the output unit, the units, then you would use hours. But since it says miles, keep in mind. Okay? So go ahead and tell me what that comes out to.
So it's,
And this is
so
money.
our rate is different.
It's the same, 19 cents
Yeah.
per what? Per
month.
per month? Okay, everybody is okay with this?
Yes.
And then after you figure out what's the unit rate, okay, let's see what questions we were gonna be answering. The first question was, what's the depreciable cost? The depreciable cost is cost minus the residual value, 57,000. The second question says, B, what's the depreciation rate?
19 cents.
19 cents per month.
Per mile.
And then the third C says the unit of output depreciation for the year. And this year, how many miles were there? 77,000. So you take the rate of 0.19, multiply that by 77,000 miles, and what does that give you? 14,630?
And in your journal, put depreciation expense.
Yes, the debit would be to depreciation expense,
Expense, and your credit would be to accumulated
and your credit
depreciation,
would be an accumulated
which is
depreciation.
14,630.
Exactly. Are you comfortable with that?
A little, yes, ma'am.
Okay, and there's not gonna be any tricks, but our next exam is gonna be heavily weighted on this chapter. Maybe 40% of the exam will be on this chapter. So I wanna be sure you're very comfortable with these concepts. So we're now looking at spreading the cost of these fixed assets out over the period that they're gonna benefit. And what we have come up with is that year, $14,630 of the cost would be depreciated. So there would be a debit to depreciation expense and a credit to accumulated depreciation. Any questions on that? Okay, let's go on to the next exercise, which is practice exercise 9-4B. And we're looking at the double declining balance method. Okay. We went over this in class last time, and I want to see how much you remember. Okay, just as a way to warm up, let's look at the 3 steps. Using the double declining balance method, what's step 1? Determine the straight line rate. And that's going to be 1 over the number of years. Step 2, double that, right? Or double the straight line rate, which is going to give you the double declining balance rate. What is step 3?
Multiply by book value.
Multiply step 2 by book value. And how do you calculate book value? What is the formula for book value? Cost minus accumulated depreciation. It's really important that you know how to calculate book value. So having said that, let's look at this practice exercise. Okay, a building acquired, and this method ignores salvage value in computing the depreciation amount in the early years, right? Okay, so a building acquired at the beginning of the year at a cost of $1,375,000 has an estimated residual value of $250,000 and an estimated useful life of 40 years. So we don't need the residual value, but we do need the cost, and we're gonna need the number of years, right? So let's go ahead and use our steps. Determine the straight line rate. It's gonna be 1 over 40. Step 2, double that. That would be 2 over 40, which equals what percentage? 5%? Okay, 5% or 0.05. Everybody okay with that? Okay, then the next step is to let's stop. Let's go back to the book and answer question A. What is a double declining balance rate? And the answer is 5%. Okay. The next step is to come up with the double declining balance depreciation for the first year. So we're gonna take the book value, which is the cost the first year, right? Which is what? 1,375,000. Multiply that by 0.05. And what does that give you? 16,000? 68,750. How many people have 68,750? How many people have a question? Okay. You're going to see questions like this on the exam. This will be a bonus. The question that I'll ask you to compute an amount using the double declining balance method, and some of you can use a bonus on an exam, right?
But then, when you journalize it, you subtract that by the.
Oh, no, when you journalize it, Chandra, can you please tell me the journal entry? She said, what happens when you journalize it?
Okay, well,
Okay.
you gonna, debit depreciation and spending,
Okay, you're gonna debit.
which is 68,750.
Okay, 68,700.
Am I right?
We'll keep going.
Oh, okay, well, accumulated depreciation,
What are you
which
gonna
is
do with that?
a credit.
Credit.
He's gonna credit accumulated depreciation, which is 68,750.
Is that the end?
No.
Is that the end?
Yes.
Yes.
I can use some points on that.
You want me, okay. Let's give her a bonus point for that. You can tell that Chandra has prepared for class. I can tell, because when people come in prepared, they are ready, right? They anticipate what I'm gonna
I
say.
love accounting.
So, questions, any questions though? So that's it. That is the adjusting journal entry at the end of the period.
Yes, ma'am.
I think you were asking about more. Okay, where do we need more? If we were going on to the next year and we had to compute the depreciation for year 2, we need to know what the book value is at the end of year 1. And to get the book value at the end of year 1, what would we look for? Cost minus the accumulated depreciation on the balance sheet, which at the end of year 1 is just going to be the 68,750. Is that what you were getting at? Anybody have any questions on anything that we've done so far? Say it again.
Is the result going to be the book value at the end of the first year?
Is this
Subtract
minus that going to be the book value at the end of the first year? Yes. That's the book value at the end of the first year, cost minus accumulated depreciation.
So why don't you journalize that?
You don't journalize the book value. Book values are just saying this is the relationship between two numbers. See, book value is not an account. You're only going to journalize accounts. It's saying that there's an expense and there's accumulated depreciation. Oh, is that salvage value?
Oh, yeah, that's right, we ignore
Right,
salvage
that's the
value.
double declining balance.
Forget I said that, ignore salvage value.
Okay,
So we also call it accelerated method, is that all right?
well, it is an accelerated method, but usually you want wanna know double declining balance method because it could be another accelerated method. And this is one of them, this is the only one you're gonna learn in this class. But if you go on to another accounting class like intermediate, you will learn that. What I'd like you to do is put your books and papers away. Just take out one sheet of blank paper. Everybody, just one sheet. Put your name on the sheet of paper, that's step one. Put everything away. This is an individual assignment, close your book. Put your name on the paper. Do you feel good today?
Not now.
We gonna see after the queen.
Okay, okay.
Let's see after this is it.
You all look very stressed, please put your books and papers away. Is there, okay. I'm gonna wait till everybody has their books. Your name is on, you can just leave it right there. Is your name on your paper? Ready? One question. One question. When you answer the one question, raise your hand and I'll come get your paper. Is that okay? Yes. And this is one question, there will be a bonus question. So, what does debit mean?
That was it.
Can you all pass the papers in? Oh, I know you can't believe it happened that fast, but that is it. Okay. And then we'll just kind of see how we put together. Have I missed anyone? So was there any need to be so stressed?
No.
No. I'm gonna go through the papers. I hope no one is gonna disappoint me. Why did I do this?
To
I'm
reiterate.
gonna go through the papers first, and then we'll talk about why I decided to make that a bonus question for today. It just seems too easy, right? You wanted this in a trick.
Yeah, yeah.
What is that? Okay, let me look through the papers. Okay, you think I can go through this whole stack?
Yeah.
You know, I think I can do it too.
Everybody.
If you see me put a paper on that side, that means there's a problem. So far, so good. My heart is beating.
Keep going, keep going.
Keep going.
Keep going.
Everybody gets the bonus. Now, doesn't that seem like an easy question?
Yes.
I put it on my intermediate accounting test. It said, what is debit? What does debit mean? Here were the choices. Left side, right side, increase, decrease. Now I know some of you might have put increase or decrease, but hopefully at this point you won't do that either, right? You're just gonna put left side. Because it depends on what kind of account, whether it's gonna be an increase or a decrease, right? Here's why I did it today. One of my accounting students, intermediate, put right side. Right side.
That's a creative.
So I said, what happened? If you don't, so when I tell you, let's debit this account and credit this account, you don't know what I'm talking about if you don't know the debit means left and credit means right. So I just believed that every one of you knew the debit meant left.
Can you put that on the exam for next semester?
You never know. It's quite possible you can see the question again, you know?
We all get it.
Because you all know the answer, but everybody. But it made me feel good that you, I did this in my other class too today. All the principal students knew the debit means left. So if I see you in 10 years and I ask you, what does debit mean? Please say left, that's all. And in case you forget, when I was a student at your level, I'm from the DC area. So all I remember was DC, debit, left, credit, right. So I'll never forget it. Because sometimes, you know, early on, you might get confused. Don't get confused. Left, right. Got it. That's it. Okay. So now maybe some of you might take intermediate, and you won't miss that question. Right? I was overwhelmed. I just looked at the paper and I said, really? Because I put the question on there because I thought it's an easy question. Everyone's, you want to have a mixture of, challenging questions and easy questions. But it wasn't for that student. So that meant probably another discipline would be better. You have to think about your future. What are you good at? And if you find that accounting is not it, then you probably just want to get enough information so you can have a basic understanding of the language of business And so that if somebody's dealing with accounting with you, you can look intelligent, or if you have a business yourself and you have an accountant reporting to you, you'll know something's funny. What I want you to do is to get in groups of 3. And you can have 2 groups of 4. Okay, 2 groups of 4, I think that can work. No groups of 2, no groups of 5. When you have your group of 3 or 4, can you send up a representative? I have an assessment for you, it's closed book. Sandra, you have to close the book. Can you send up a representative to get your assessment?
I'll go get it.
And do what you can. Make sure you read the question. It's important to read. All your names on the paper. What, your group? Groups of 3 or 4. That should work. What group are you in? That's not 3 or 4. Those 3 or 4. Read the questions, answer the questions, and turn in your papers.
Minus the 30,000 over the 5 years.
You ready again?
Even then, whatever you get from that, you need to divide it by 5.
And this right here is that's right there, right? And divide by.
Oh, okay, so we're just using a different number.
That's why you do the 1/5.
Or is this the useful one? You subtract this and this 100%.
For the straight line, you do this minus this divided by that.
Divided by this? Okay,
Yes.
I wasn't sure if it was
So that's 3 point. Cause it,
It's
double
closed
the
book.
cost. That's 1/5.
It's closed book, closed notes, lady.
Which one?
Oh,
The double
okay.
Yeah, the
That
1/5.
one
So
is
it's
closed
2/5.
notes.
Yeah, 2/5, which is double. So you don't get the percentage.
Oh, no. 1 divided by 5 equals 0.2
So what's the rate? Yeah. That's
20%.
Yeah.
Like 40%.
And then we got time for
Oh, that's when you do this, times the cost, times the cost, The cost is just like
But for this, you would need to double them.
No. So what's?
Can we use
You don't know, it's, yeah. You know the output, it's just the rest of the
Is it what's 126? I think so. No, whatever it is, please, you subtract the 214,000 minus the 50,000, and then you multiply that by your decline rate.
That was the last one, right? I swore you see double. No, the doubling is the
This right
decline.
here? Oh, no,
But
I think it's
the
this.
units of output is just the third step. The unit of
This
output
right
is
here.
just.
That, nah, no. I'm trying to tell you.
Yeah.
This cost salary value, then you divide by, life. I know. So So that.
And when you finish, you can turn in your papers.
It's the straight line times, what, the rate, then the rate. And then you times by the number of units that you get from the rate. So, yep, okay.
That's right.
214,000.
You can use the, that you call.
That's right.
Minus 30,000.
Definitely, multiply.
Right here.
To get the rate.
I think we do. Yeah, we do.
And what it, also when you put it divided by that, then you multiply by the 9,000. Bam. There it is. I'm getting this accounting down pack at the last minute. What is the book like? I got it at the last minute.
But you're getting it.
Yeah.
You're doing something different, I can tell.
Read, exactly. Reading and practicing, reading and keep doing
Okay,
it.
see, I got the book value, cause I times that by.
Yeah, check it 4 times. Check it 4 times.
I'm sorry.
It said 4 years.
Yeah, I'm about to do it. Let's get it on my birthday.
That's what it said.
Okay, yeah, one group is ready to turn something in?
Yes.
The book value always go up. It always go up. Depreciation expenses are always different.
Yeah.
No, because you're using the unit.
That's the book value stayed the same.
These are your final answers? So, okay. Some do, some don't. I just want to know what is the depreciation for the year? That's what the question is. As long as you read that and answered it. The question is, what is the determined depreciation for the year?
Hold on, Dr. Wood, hear me out.
It says determine the depreciation for the year. Everybody see that? That's what I'm asking.
You hear that? For the year.
For the year.
For the year?
It says determine the depreciation for the year.
Use the straight line. 4 feet.
Oh, okay.
Oh.
I'm talking about the first 3 questions, right? Those 3 is depreciation for the year.
Minus accumulated.
I know you take that out.
Oh, depreciation. Yeah, it is.
Minus accumulated depreciation.
Make sure whatever you turn in, everybody agrees on the answers, because everybody's gonna get the same grade. You have 2 more minutes. Whatever you can do in 2 minutes, go ahead and do that, and then turn in your paper.
And then whatever answer you times it, whatever answer you do times it.
So,
And do we put the bonus on top?
I'll remember the bonus. You know you have to put it, because I know everybody's going to.
So what's that?
equals
And we said it was 86.
What should we divide? That's what it is.
What's that? The units of output.
Okay. Other groups, we have 1 more minute.
Oh, gosh.
What's the first one? Oh, it was 68.
And you all, your group, you saw that the question was to determine the depreciation for the year, right? And those are the answers you gave me for the year.
Oh, you did that?
Depreciation for the year.
I think you also take one, I think is if you take this answer and subtract it from that answer.
Can we get all the back?
That's what Ms. just did. Times it.
I want the depreciation for the year, that's what you're asking.
Oh, for that year.
For the first, yeah, it says for the first year, right?
Oh, when I said the fourth year.
No, I said the first three questions. The first three questions, determine the depreciation for the year, 1, 2, 3.
Oh, we did, we just doing this.
Oh, then, well, that's different.
Yeah.
For 1, 2, 3, I just want to be sure. Okay, you all have 20 seconds, whatever, you can do in 20 seconds.
Use a structure.
Okay, groups, start lining up, make sure your names are on the papers. You ready to turn it in?
I got 700.
No, whoa.
Okay, group in the back, bring your papers up. Group over here, bring your papers. Group in the front, bring your papers. You okay? I'll take it. Great. Okay, me too. Thank you. Interesting, okay. Oh my goodness. Wow. Oh dear. Let's see.
Okay, see, Dr. Wood,
Wow. Wow. One more group, am I waiting on one more group? Can you bring your papers up?
She got a variety of answers.
Wow. You know what? I think I'm gonna work from the bottom up on this one.
Wait, Dr. Wood, now hold on before you get a little bit of, just calm down and think.
I'm trying to calm down.
Just calm
I
down
don't
and get yourself
understand. I
together
don't
first.
understand what's happening. You need to turn your papers. Okay, we're gonna start at the bottom up. We're gonna start with the last question first. Okay. Okay. Which of the following is true? We'll start with that, right? Let's look on page 415. There is, in the middle of the page, a problem that shows what happens in the double decline and balance method, right? And look on the right, do you see book value? And over time, what's happening to book value?
It's going down.
Does book value go down over time?
Yes.
It does. What goes up over time? Accumulated depreciation. So the answer is B.
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 Oh, well, we got that one.
B. Book value goes up. How can book value go up over time if book value is cost minus accumulated depreciation? There's no way. Okay. Next. We'll go back to the beginning. Now we go back to the beginning. The straight line method. Straight line method. Oh boy, oh boy, oh boy. The question was, determine the depreciation for the year. So let's just look at the process. Cost, 214,000 minus the salvage value, 30,000, divided by the number of years, which is 5. Can you do the math and tell me what you get? 36,800. Everybody agree with that?
Yes.
That's correct. If you have 36,800, you get credit.
Okay, we got that one.
Okay. Next, the double declining balance method. Do you remember the steps?
Yes.
What's step
Determine
1?
your straight line
Is
rate.
1 over 5?
5.
Then the next one is going to be double it, which is going to be 2 over 5, which is the same as 40%, right? And you multiply that by the book value, and the book value of the first year is the cost of the asset. So you're going to multiply that by 214,000. Can you do that for me? What's 214,000 times 40%? Okay, let's do it. You all have calculators.
85,600.
Do you agree with that number?
Yeah.
Does anybody have a question on that? So, I'm looking for the number. And I don't see it on this paper. And I don't see it on this paper. And I don't see it on the paper. I see it on the paper in some cases, but for the wrong method, so. Okay, we ready to move on? Nobody has a question on this? Some of you looking kind of disappointed, but you do understand the process?
Yes.
Okay. Because you know you're gonna see something like this in your future, right? Okay. But it won't be a group exercise next time, it will be an individual exercise. Your third exam is the Monday before Thanksgiving. And you will see questions like this. Okay, the next one was the units of output method. How do you do that? You take the cost, 214,000, minus the residual value, 30,000, divided by the number of units for the life of the asset. How many hours? 50,000?
Yes.
Okay, can you tell me what you get when you take this minus that and divide by 50,000?
Is it,
How much?
is it 180?
You all have calculators. What do you get? We do this minus that divided by what?
368.
360? 368. Does more than one person have 368?
Yeah.
So that's the rate, 68 cents per what?
Jesus.
This is per hour.
Put that for the first.
Okay. And now we have to look to see how many hours were that year.
And it was
9,000 hours. Can you multiply this number times 9,000?
You get 120.
How much?
33,000.
You all got 33,000? 120? Any questions on the process?
Oh, yeah, we did.
No questions? So we're looking for the number,
Yes, we did.
33,000. You got it right.
I was like, thank you.
Can we see him?
I'll give it back to you.
That red pen is on.
Yeah, that knows the. Any questions on any of the methods? Because we're gonna move on to something else.
Okay.
Some of you could use that bonus fund, right?
Yes.
Oh, we have one more thing.
Oh, Lord.
Okay, now, this is what I really don't understand. What's the cost of the asset, you all?
The cost of the asset was
214,000.
How are you gonna get book value that's more than the cost? How can you get the book value that's more than the cost? Isn't book value cost minus accumulated depreciation?
Oh, yes.
So if you had a number that was bigger than 214,000, you knew it was wrong. Because you can't subtract anything from 214,000 and end up with book value. You know, okay. So let's work on this. I said fourth year, at the end of the fourth year using the straight line method. So what you need to know is how much is the depreciation every year. Okay, so let's do this. You said that the straight line method is gonna be 36,800? Okay, get your calculators out. So year one is gonna be 36,800, and year two is gonna be 36,800,
So you talking
and year three is gonna be 36,800, and year four is gonna be 30,000. Okay, so when you do all that, what's gonna be in accumulated depreciation at the 147? 200? Does everybody agree with that?
We did.
So this is accumulated depreciation, right?
Minus.
So now, to get the book value, we're gonna take the cost of 214,000 and subtract
Yeah,
147,200.
we talking about.
And what does that give you? That's gonna be the book value. Just go ahead and do the math. So, is your hand up? You don't have a question?
Something like 7.
It's 66.
How much?
66,000.
So if you have 66,800 on your paper, you'll get it right.
Can you throw that out?
We talking.
I saw 708,800. I saw 708,800. I see $855,918.24, and I
I
see
think we might. We need to get the first
66,800. One group got it. Okay. So I'm going to go ahead and record these grades. You all, we got near the end of the semester as far as the points are concerned, right? 1. And so after today, we'll be at 90 points out of your 100 assignment points. So I have 10 more points to get up to the 100, and then I'm going to give you another 10 points worth of work. So between now and the end of the semester, you'll have 20 more assignment points. Now let's look. Some of you are doing pretty good, but remember you can't get more than 100 assignment points. When you get to 100, you max out. That's where you stop. Who's that? There might be somebody in here who might get to 100. I'm gonna say the person, there are two people who might get to 100, because they're real close to the maximum now. So I'll keep checking on your grades, and you check too. This is how you can tell how many assignment points you have. Look at your total points on Blackboard, and subtract from that your 2 exam scores, and that'll tell you how many assignment points you have.
I just count them all up.
You really count them, you really add them up?
I got like 75.
Let's see if he does it, since he does it that way. I think it'd be faster to take your total, and that's part of it. Yes, But Devin, just take the total. Just take the total points and subtract your 2 exam scores, it's faster. Okay?
Ooh.
So he has 75, and you're trying to get to 100, and there are 20 more points to go. So, and that was 75 before today, so today you got a few more.
And the bonus. Can't forget about bonus.
Everybody gets the bonus for today. Let's look.
Can we see how many points we have?
On the way out if you want to. Let's go to page 417. I'm going to talk about depreciation from the IRS perspective, depreciation for your income taxes. And I'm doing this, I want you to go over this page because you're going to have to do this yourself. If you ever own any rental property, or if you own a business and you have something like a car that you want to depreciate for tax purposes. So I want you to know, how does the IRS look at taxes? Everybody see where I am on page 417? So I'm going to hit the highlights. Anything I highlight today is something I want you to be sort of remember. The Internal Revenue uses a system known as MARCS, M-A-C-R-S. You see that? It's the Modified Accelerated Cost Recovery System. So at least if you see the term MARCS, you'll know that has to do with IRS and taxes. Any questions on that? Okay. The IRS classifies fixed assets that are going to be depreciated into a number of classes. There are actually 8 classes, but most often 2 classes are used. The companies don't just decide how long they're going to depreciate their assets. They don't determine the useful life. The IRS says if you have this kind of asset, it's going to be 5 years. If you have this kind of asset, it's going to be 7 years. So note on this page that the 5-year assets will be something that, like cars, automobiles, or trucks, those are 5 years. And that's what the IRS tells you. So you don't say, I think my truck is going to benefit the business for 7 years. For tax purposes, it's 5 years. And then machinery and equipment, that's 7 years. So you might want to remember. So you don't say, I have this machinery, I think it's going to be only around for 3 years. I want to depreciate it for 3 years. You depreciate for 7 years.
What was 7 years?
Machinery and equipment. Cars and trucks, 5 years. So the IRS sets the standard on how long you're going to depreciate. The method that's used is an accelerated method. It's very similar to the double declining balance method. Okay, so it's going to be more, it'll be higher depreciation in the early years. If you were filing your taxes and you were recording depreciation, would you want to have more depreciation expense or less depreciation expense? What would you want? You want less depreciation, and you want less? Who said more? Amen?
What you want, listen?
Who said more?
I said more, just,
Why would you want more?
I don't know.
Just because they said less?
Yeah. Right.
Anybody have a reason that you really think you have an idea really? If you, because when you're filing your taxes, you want to know what you want the outcome to be. What do you think?
Okay, I would say more.
Okay, and why?
I think because if it's depreciating more, you won't have to pay as much taxes on it.
Okay, more. The higher, that's why people want to have an accelerated rate, because the more expense you have, the less tax you pay. So I'm talking about for you all. If you had an asset, you had an equipment, a computer or something for your business, and you're depreciating it, you want more expense, because that means you're going to pay less personal income tax. It's based on your income. So when you have more depreciation, you're going to have less income, and less income means you pay less tax. You want a bonus for that? Sure. I'll give you a bonus. That would be. Today, I think a number of you can use some bonuses.
Yes, please
Okay.
So,
Bonus. That's in addition to the other bonus you got. Okay, so you understand, more is better when you're filing your taxes. More expense. Look at the middle of the page. Okay, there's a chart there and it has a number of years and it gives you exactly what percentage can be depreciated each year. according to the IRS, if you're having if you have a 5-year asset or a 7-year asset, you depreciate those assets for only half the year that the asset is purchased. So basically what the IRS is saying, whenever you buy that asset, whether it's January, October, or December, the first year you will only, they consider it as though you bought it in the middle of the year. It doesn't matter when. And then when you sell the asset, they always assume that you sold it in the middle of the year. That's just one of their rules. So you all follow? So you got that. Unlike, so there'll be partial year depreciation the first year. I haven't asked you to compute depreciation using a partial year method, because I figured if I can get you to understand just the basic depreciation methods and how to calculate depreciation for a whole year, I feel comfortable. But, yeah, basically. I think Devin's got the concept there. Devin, if you need, I don't know if you need a bonus point. I know you have 75 points.
No, I need, and I never get bonus points. Never fast enough.
But you were that time, huh? Yeah, I didn't even ask you, Devin. That would be horrible. Okay. So having said that, and I said the IRS they have specific rules. And so these are things that you might want to remember in the future, right? So there's a lot going on this page. I would read the page and I would highlight things that I'm talking about. I said they assume that all assets are purchased in the middle of the year, and when they're sold in the middle of the year. Let's look at this chart in the middle of the page. You see it says year 1, year 2, and it keeps going on down to year 6. A 6-year asset. Look at the first year. They're saying, the IRS is saying that for a 5-year asset, you could depreciate 20% the first year. And in the second year, 32%. And then in the third year, 19.2%. Why do you think year 1 only has 20%? This is an accelerated method. This is a double decline. It's similar to double decline and balance. Why would they have only 20% of the assets cost depreciated in the first year? Raise your hand if you have an idea.
What was the question?
I said, why do you think in the first year the IRS would say you can only depreciate 20% of the assets cost? And this is an accelerated method, so why is it going up? The second year it says 32%. Raise your hand if you think you know. Anybody? Nobody? Okay, it's connected to what I just told you, which is that the first year, the IRS is assuming that all the assets are purchased in half. Yeah, so basically, that 20% would be for only half a year. So if it was looking at a whole year, it would have been 40%. And then you notice here, even though it's a 5-year asset, did you see that it said 6 years? Because half of the year is counted. Where the asset is purchased only half of the year for the first year, and then the other, when it's gotten rid of, the other half is in the final year. Okay, do you think you could depreciate animals? Yes, and how do you know? Or you just thought that? Okay, one other way to know is by looking at the exhibit at the bottom of the page, which talks about depreciating animals. Yes, you get, if you're a farmer, you have cows and you have pigs or hogs or whatever. I think I was kind of interested to see they have classes for those animals, and it actually tells you the number of years over which you can depreciate the animals. Now, that's not going to be something that will affect most of you because you're probably not going to go into farming. But if you did, you could depreciate your animals. There's a little footnote at the very bottom that talks about the real estate. This is something you might have to deal with, because if you buy a house and then you move out of your house and you can't sell it, you might rent it to somebody. If you rent it to somebody, depreciation is part of the cost of what are your costs. So that can help to reduce your income. They might be paying you $800 a month rent, but you can depreciate the cost, and that will reduce your taxable income. But look at the number of years. See that you don't just determine over how many years. The IRS tells you how many years. Do you see that? It's going to be 27.5 years, or it's going to be 31.5 years. So if I gave you a multiple choice question and I asked you over how many years, and one answer was 5.5, another was 12.5, another was 27.5, and another one was 200. Would you be able to come up with the right answer? Okay, so there's a lot on this page. Finally, did you notice what method is used for real estate to depreciate? It's straight line. So for your computer, would it be straight line? No. Computer would be in that class of 7-year assets, right? And 7 years, and that would be it's going to double decline balance method, an accelerated method. What about your car? Would that be straight line? No. The things that are straight line are real. It has to be real estate. If you're dealing with the IRS and taxes, the other ones are going to be the accelerated method. Okay. So are you all, do you see the kind of questions I can ask in the future? Okay, going on, let's look at page 419, getting rid of assets. Yes, you have a question?
About the computer, you said the computer will be able to accumulate it?
No, I said a computer would be, it would be an accelerated method.
Okay.
It's a 7-year asset,
Right.
and those 7-year assets are going to be depreciated using a method similar to the double decline balance method.
Okay, because it's like equipment and.
Yes,
Okay.
and machinery, that's fine. Okay, on page 419, talking about getting rid of assets. Okay, when you get an asset, let's say equipment, you debit equipment.
Right.
So when you get rid of equipment, what do you think you have to do to the account equipment? Credit. You got it?
Yeah.
Okay, accumulated depreciation. What's the normal balance for accumulated depreciation?
Credit.
It's a credit. Remember, it's a contra asset account.
Which one?
I said, what's the normal balance for accumulated depreciation?
Okay.
Okay, so when you get rid of the asset, you're gonna have to get that account off the books, and you would debit accumulated depreciation. You got it? Okay, just the basic concept. When you get rid of an asset, you have to take off the books everything that relates to the assets. So if I had a journal entry, and I ask you which one of those represents getting rid of equipment, if I debited equipment, would that be the answer? No. You're gonna definitely look for credit. And remember, it's gonna have to show something with a debit to accumulated depreciation if you're getting rid of equipment. Any questions on that? Okay, I'm gonna get into another concept. We just have a few minutes left. And you think, how quickly can I get at these concepts in? Watch this. Let's do this. A book value, some equipment has a book value of $8,000. And it's sold, okay, for $8,200. Do you think that's gonna be a gain or a loss? Gain. Can you see it?
No.
You got it. If it sells for more than the book value, it's a gain. Can you tell me how much of a gain?
$200.
See, for that fast? Okay, what about a loss? Okay, I don't want to say that. If it's sold for $7,700, would that be a gain or a loss?
A loss.
Loss, because it's sold for less than the book value. Can you tell me how much of a loss?
$300.
$300. Would you like to see this in your future?
Yeah.
You're gonna see it. This is an easy concept. Losses, by the way, if you were gonna prepare the journal entry, raise your hand if you think you know whether a loss will be debited or credited, if you're pretty sure. Raise your hand, yes, Tristan?
Credit.
No.
Well,
Why? Losses are similar to expenses. So if you want to remember, expenses are always debited. Losses would be debited. What about gains? What do you think?
Credit.
Oh, you all got it? Okay. Natural resources on page 421. Natural resources are things like oil wells, timberlands, and I'm talking about land that has trees on it. I'm not talking about the boots, okay? So an oil refinery, the timberlands, a diamond mine, things that have products that you're trying to sell off the land. Those are natural resources. And that cost is spread out using a process called, raise your hand if you know the answer. You got it, raise your hand, then answer. It's called depletion. You see it in the middle, is it written there on the page in bold terms? So do you think,
I can tell
okay,
you the formula.
you know the formula, you know the method? Okay, who said it?
No, I'm just
Okay. Do you know the method? What method? Just tell me the method. It's similar to which method?
Depreciation rate minus cost.
No, but just tell me, what method is it similar to? We talked about different methods. What method is it similar to?
Units of output.
Units of output. That's it. So the natural resources are spread out their costs using a method not called depreciation, it's called depletion. And it's using a method similar to units of output. So that would be your question. Let's see. Any questions on anything so far? Because I'm about to wrap it up. So anything I'm talking about today, basically these are the highlights. That's the takeaway. So I'm not going to ask you to do computations as far as natural resources. The last thing is intangible assets. Tangible assets are assets that you can touch, that are going to benefit the company for many years. Intangible assets are assets that are going to benefit the company for many years that you can't touch. Examples are trademarks, patents, copyrights. So you, and goodwill.
Live assets, right?
Say it again?
These are long-lived assets.
Yes, they're all long-lived, and that you can't touch them. So if I ask you for examples, would equipment be an intangible asset? No. Would a copyright be an intangible asset?
Yes.
Yes. And the process that's used to spread out the cost of intangible assets is called, raise your hand if you know, amortization. On page 422, do you see it in the middle?
Yeah.
That's it for the bonuses for today. But I want you all to know the terms. You have those three different terms: depreciation, depletion, amortization. And you know some examples of intangible assets, and you spread the cost out over the intangible assets over their life, useful life, or the legal life, like a copyright. You can have a copyright that goes 70 years beyond the author's death. So if someone wrote a poem, it was copyrighted in 1800s, that poem is no longer copyrighted because one, they're dead and it's been more than 70 years, so anybody can use that poem. Or that song, the song is copyrighted, or a book. Are you all okay with that?
Yes.
So it's not gonna get any deeper than that. We'll finish this chapter. I hope you have a great weekend. We're gonna move on to chapter 10. I'm gonna come back on Monday. No homework. Amortization is an amortization goes
Intangible assets.
what page? You all tell me what page is it? Intangible assets. The cost is spread out using the method amortization. That's what it's called. You see there's a bold term on the page there with intangible assets?
Yeah, but aren't you gonna use the other word? You're gonna use the tangible asset. You're gonna use the other word.
No, that's the type of asset. The intangible assets are like the contract patent. They're worth long.
Yeah, I understand that, but like if you would ask us the question, you're not gonna use the other assets, you're gonna use the word.
Amortization?
Yeah.
No, I'm gonna ask you what process is used to spread out the cost. If you're gonna tell me, you're gonna say amortization or depletion or depreciation, you need to match.
Where's amortization at in the book?
Where's it show up? Okay, you all, where is it?
I see intangible asset, I don't see it.
The amortization, show them where the word shows
It's
up.
under
Oh, all right.
Okay, any questions, or you all wanted to see points or something like that?
Oh, yes, please.
If you wanna see your points, just line up and I'll tell you how many points you have, okay? And this is out of 85 at the time I tell you.
Yes. Hang on one second.